Welcome to another free weekly webinar presented by Axiom Founders Family Office. I'm Thomas J. Markey, CPA and newly appointed or have passed the Certified Exit Planning Advisor program. I'm joined with Armando Roman, my business partner, and this is our weekly presentation of death, taxes, money, and the law, where we cover retirement planning, income strategies, tax smart investing, estate and legacy planning, insurance and risk management, and some business owner strategies. So, anyways, we've had a few other webinars where we talked about tax planning, and I always kind of started out with a joke that we do a lot more investments. Well, today we are going to kind of talk about investments, and that's the different vehicles that investments are inside. So I welcome Armando Roman. Armando, thanks for joining me today.
Yep. Hey, Tom, how you doing?
So today's subject, we're gonna talk about some different retirement plans that are available, which we talked about before. The investments will go inside those different vehicles. So Armando, where do you want to start with this checklist?
So yeah, let me set the broad picture, Tom, on retirement plans because people often get confused and don't quite understand what these are. They all fall under the broad blanket that's called a qualified plan. That's an IRS term. They're called qualified plans. And the right type of plan for you, for the listener, it depends on what the business structure is, what the entity type is, the number of employees you have, and what kind of income you get, and what kind of income you're expecting going forward. So I know I said a lot in that, but it's a broad category. What we see in front of us is this table of about six different columns of entities, and each of these different entities serves a different purpose in a different situation for that business owner. So we'll talk a little bit today in this conversation about when those are appropriate, what conditions make the most sense for you to really want this one versus that one, and that's what we'll talk about today.
Right. And I kind of recognize some of these numbers. These are we see 401k. That's probably the most common one in that's a tax code, right?
Right, exactly. So the 401k, these things are often what we refer to as 401k. It's a code section of the IRS. And we just call it a 401k. Well, that sounds nice and simple. And it sounds like, literally everyone has one for their company and people know what the heck they are. But there are different little tweaks and levers that you can put in them that can make them fine-tuned and be a better fit for your company. And so that's why when you're working with somebody on getting a 401k put together for you, it's not just pull this thing off the shelf, put your name on it and put it in place. Yeah, you can do that, and many people do, but it can be tweaked so that it really is a better fit for your company, for you, for your employees. And that's part of what we do as we implement 401ks. We've got, Tom, what about 5 or 6 in process right now for clients?
Sure.
Brand new 401ks?
Yeah, and maybe it's good if you touch on that sometimes people think it's an all or nothing, and then also, what is your role as far as like you said, that what was the role as far as setting up these plans that you talked about? What kind of questions were you asking, maybe?
So I think of us and what we do really as being a guide. The business owner doesn't know anything about this stuff, and why should they? They're busy running a business. That's where their expertise lies, whether they're a physician or they are buying and selling real estate or they're manufacturing lawn chairs, whatever it is, that's their business. Our space is understanding this part of the retirement planning picture, understanding the tools, the strategies, and the tax codes that matter so that we can help guide them to what the best fit is for them. So I spoke with a business owner today who has about 35 employees. He has a cash balance plan and a 401k. For him, that setup makes a lot of sense. But that setup would not make sense if he had 300 employees and had a different business model and different types of people on board. So our role is to be the guide, to understand enough about these different plans to guide towards the right plan. And then once we have an understanding of where that really needs to be, then then we bring in the actuarial firm or the third party administrator, and we have the conversation with them so that we can engage them to draft these plan documents and get all those things lined up that need to be lined up to comply with ERISA, with the IRS, and all the federal mandates and guidelines that are required to set this up and operate it every year.
Right. And then, and as you said, some of these business owners, I know what the plans you're kind of working with, when their Department of Defense contracts that they're kind of requiring these folks to have retirement plans. Other business owners, they want to offer it to their employees as a benefit, but holy cow, these business owners, they don't even know where to start. I mean, they're
Right.
busy enough as it is.
Right.
Then they want to offer this benefit. They want to be nice to their employees. They want to retain key employees. But back to, I mean, look at this solo 401k. Sorry if they have our profit sharing, simple IRA. This is just a few of the
Yeah.
potential retirement plans.
Yeah.
Maybe talk about maybe the cost or some of the other factors that influence
Yeah.
decision making.
So, yes, it's not, it's often, I'd say that when a very small employer says, hey, I want to start a 401k plan, I will often talk them out of it because what they don't understand is every 2 weeks they've got to pull money out of payroll and then get that money from the payroll account into the hands of the 401k company. There are annual requirements, there's an annual cost, and there's a lot of admin that has to get done on a very small 401k plan. But on the right-hand column of what we're looking at here on the table, the SEP IRA is kind of the opposite. It's super simple and extremely inexpensive. Literally zero cost to set up your SEP IRA and put that in place. And it's real simple math. It's a percentage of the profit you have in your business. That's what you can put in each year. And you can put in that as the maximum or anything down to $1. So it gives you a lot of flexibility, zero cost. Other end of that scale is what's called a cash balance plan or a defined benefit plan. But then you add a 401k with a profit sharing with safe harbor contributions. It can be pretty complex really fast. But again, our role as that guide is to help design this plan for the benefit of that business owner, then have that meeting with the expert, the company that actually drafts these legal plan documents. They create these trusts, which is really what they are. And then again, we're guiding the business owner through this process and walking them through the process, because if they go it alone, they're going to get lost. They're not going to end up in the right place. And it just can be an extremely frustrating, expensive, time-consuming process for them.
Yeah, holy cow. I mean, I don't know if you don't want to be going alone. So maybe let's talk about the key players that are involved. So we talked about you, the advisor. So your role is you're asking these business owners questions, and then we kind of go to our third party administrators. So
Well,
maybe
yeah,
touch on that, and then maybe where the assets are held.
yeah, and let me talk about that. So I personally worked with qualified plans for almost 40 years. It's been a long time. I am not a spring chicken. These plans have changed over the years, but they've kept that same basic structure all the way through and the benefits all the way through in large part. So it's pretty easy for me to have a conversation with somebody about their situation and what plan might be the best fit for them. That's pretty easy to do. We become the advisor, often called the broker on the 401k, and we are the point person on that 401k. So once we have that conversation, and yes, it looks like owner really should do this, another key part of that is what's called the third party administrator. The acronym is TPA, third party administrator. What they are basically the bookkeeper. They keep track of all the money going into the plan, all the money coming out of the plan. They keep track of all the money that belongs to Mary and to Don and to Alex. So all the individual participants in the 401k plan, they're putting money in, they're getting earnings, they're getting fees, they're taking money out. Somebody has to track all that. That's what the third party administrator does. They do all that tracking for them. They will also file the annual 5,500 tax filing requirement on the plan. Now, somebody also has to draft the plan document. That is also the TPA often. They're sometimes called, well, they're called actuaries, they're called TPAs, third-party administrators, but somebody has to draft the legal document that complies with all of the ERISA requirements to create a separate trust, which is the actual plan document. The TPA does that. Then you have to have a 401k company. We use Empower. They're the second largest 401k company in the country, and we like them. Been with them, I don't know, 15 years or so. We like what they do, and they do one key thing that many 401k providers don't. And this is important. I hope that you listening, I hope that you pay attention to this, if nothing else. When you have a 401k and it is your company, and now you put this 401k in place for your employees, I would compare this to giving your 16-year-old teenage son a car and just handing him the keys. Well, if you do that, he's going to hurt himself and probably somebody else. You've got to teach them to drive. And so Empower, the way they do that for us is when we have a 401k plan that we put in place, and let's say they have 100 employees, those 100 employees need to get guidance on what to do in their 401k plan. So Empower has people, dedicated people, that is what they do. So the employees can get on the phone and call these people and get that guidance they need so they can really make this 401k plan work for them and their family. So that's the 401k plan. The 401k provider, then say Empower, then they will contract with money managers and fund managers. So Vanguard is a fund manager that we've all probably heard of. So the investments that are in that 401k plan, Empower is not investing the money. Instead, they contract with Vanguard, with iShares, with Fidelity. And so then those are where the monies actually get invested. And those have professional money managers who are managing the different investments in that. So there's a lot to it. And if you've never gone through this process before, it can be overwhelming. Like I said, we've got about 5 in process right now. Yeah, about 5 in process right now. And for 2 of these business owners, they've not gone through this process before. They haven't. So it can be a lot to do, a lot of admin to get it put together.
Right. So just to kind of summarize that, so Armando mentioned what we call a custodian. So you have your third party administrator, which takes care of um, this 5,500 form filing. So they're kind of keeping track of what the IRS wants as far as qualifications for these retirement plans. But then the custodian is so these employees are deferring this money. You can see the limits here. So let's say they defer the limit, 23,500. Now they have to make a choice of how they want that money invested. So you will commonly see inside of these custodians what they call target date funds. You'll also have maybe some ETFs, maybe some mutual funds. Mondo, maybe let's touch on the 338 and the 316 and how we kind of look at
Yeah.
that, what roles those play.
So I'm glad you brought that up, Tom, because if this is all brand new information to you, the listener, and you're thinking you want to get a 401k in place for your company, we set them up always with fiduciary protections in place. Well, what does that mean? There's 321, 316, 338. Those are, again, code sections in IRS tax code. But what they basically mean is you, as the business owner, when you set up a 401k or any type of a qualified plan for your employees, you are also what's called the plan sponsor. And you have a fiduciary responsibility to your employees. Well, people often don't know that. They just don't know that. So all the plans that we put in place, we make sure that there is a couple of levers that we always engage with the 401k, 338, 321, 316. These are fiduciary protections for that business owner. Well, what does that mean? Well, the plan sponsor is the business owner, and the business owner, if you put this 401k in place and you don't watch the investments so that they're keeping up with the market, with performance of their general asset class, if you don't keep an eye on the ball, well, then, there are a lot of lawsuits in the 401k space from employees suing the employer because, hey, employer, I put my money into this particular fund. And when I look at that one compared to all the other in that same asset class, it's a poor performer. So we make sure to put in these fiduciary protections in place, which protect the plan sponsor and protect the employee. They are then in the plan, it's built in that there is an outside third-party company watching the investments to make sure that those investments are keeping up with their asset class, with the others in that same group. And if that particular fund family or that fund falls behind, then it's replaced automatically with somebody else in that same asset class. And that provides tremendous protection for the business owner, who is also called the plan sponsor. That's what those fiduciary protections are for. Yes, you're going to pay a little extra money for them, but we always put those in place because it matters. Business owners are too busy running their companies that they don't want a new admin task, and they can avoid it by having the fiduciary protections built into their plans and automate that.
Right. Yeah, that's because yeah, this is I mean the IRS initiated these because we understand there's a need for folks to be saving up for retirement. So the 401ks and some of these other options they're great options, but holy cow, yeah, they could be a little bit this, that, and the other. And as we see all these different mumbo jumbo, that's where you want to have somebody like an Armando on your team who not only has discussions with you, but also we look at the cost too of these plans. We understand that running the business is not easy, so we want to avoid as many costs as they have. But then back to adding the 321 and 338, our job is to explain that to the business owner. It's well worth it to pay for this extra cost.
Right, right. And on that second column there, safe harbor. Safe harbor is a term that basically means it, safe harbor means that you add this particular uh, option to your 401k that's called a safe harbor. And there are two ways to do it. But when you add this safe harbor into your 401k plan, then that means the highly compensated employees in the company, as well as the owners in the company, that they can then max fund their 401k plan every year because they've added safe harbor. And in essence, what that means, the messaging the IRS says with us is they say to the business owner, we will let you max fund the plan for yourself individually and for your highly compensated people, but you have to bring your employees along with you. And that's what is called the safe harbor. And it can be some plans have it, some plans don't. And it gets back to what is that business owner really trying to accomplish? And does having a safe harbor plan make sense for your company or not? Well, it depends. Depends on what you're trying to accomplish, what your situation is today, what your what's called the employee census looks like. But a lot of pieces come into play in designing this plan so that it makes the most sense for you.
Right. All right. Great summary there. Are you ready can you take a couple questions?
Certainly.
So we got a question here. It's a business owner. It says close to 200 employees. They have a 401k. He has not reviewed it he says, a couple of years at least. Anything that he should be concerned about?
Yes. Yes. The first thing I would look at is, do you have the fiduciary's protection? Do you have the fiduciary protections built in to protect you? Are those there? Do you have them? If you don't know if you have them, check. And what I mean by that is call your broker on your 401k plan and ask them, hey, what fiduciary protections do I have built into my 401k plan? If he says, well, what do you mean? Well, that's a really bad sign because he or she should know exactly what you mean. If they don't know, and they can't answer your question, then you might call your 401k provider directly, meaning call Empower or call Fidelity or call whoever is your 401k plan and talk with them because they will know if you have those built in and if they are in your 401k plan as well.
Yeah, great answer. And I'll piggyback on that. I mean, I'm at our firm, we push for reviewing at least once a year. So we will have a phone call with the owners. Armando had several of those recently. He was able to get a discount on the plan because all of a sudden the plan assets they went over some certain thresholds, and these custodians will provide discounts on that. Plus, things change in the business. You know, sometimes as you grow, some of these plans need to be changed or moved or transferred, et cetera. So, is the plan you have still the right plan for you and your employees? So,
Right.
another question here. So, we got a business owner. He's got several employees that don't work at his business no longer, but there are the retirement plans are still with the business. Should he be concerned?
I wouldn't say you should be concerned, but there are ways that if their balances are if those former employees, if their balances are below a certain threshold, then you can push them out of your plan and roll that money into an IRA for the benefit of those employees. Some employers do that, some don't. Um, if you keep them as part of your 401k plan, that means you have to account for them. You're paying your third-party administrator every year to track the balances in their accounts. So the employer is incurring a bit of an added cost by keeping them in there. But at the same time, if you try to get employees out and you can't find them, that's another admin exercise to go through that it just might not be worth it. I mean, for the actual out-of-pocket costs annually to keep those people in your plan, it's probably worth it just to leave them there. Should you be concerned about it? I wouldn't say you should be concerned about it, but those people, you should have their current address if you can get it so that they can get their statements at least once a year. But there's just not a whole lot you can do when an employee leaves your company and you don't have their forwarding address. Just not a whole lot you can do.
Right. And I'll piggyback on that. What we try to do is get somebody out to the work site at least once a year to do an education. So as I mentioned, we use some custodians. Ours, the ones we like are Empower, but there's other custodians out there. They should have somebody that's available to help educate your employees on these subjects. So back to, if you're getting ready to retire, what are your options to do with this
Yeah.
retirement account that you have?
Yeah.
Some other questions are, is a Roth available? Should I do a Roth or not? So anyways, a lot of times these educational events for the employees can touch on any kind of subjects, and they offer incredible financial planning advice. And that way, maybe you kind of avoid some of these situations on down the line.
Yeah, but I'll add one thing, Tom, as well, that if you look at you know, if you look at people who have retirement monies when they retire, most of that money that they have, if not all of it, is in their 401k. So employers are doing a tremendous benefit for their employees when they have a 401k because often that becomes the only tool that that employee has used to save any money at all for retirement. So employer under when employees understand that, they understand that that's also tremendous responsibility, and some people want to embrace that responsibility, some people don't. But what I would say is when you have a 401k in place for your employees, make sure they're also getting some help from the 401k provider or from the broker on the plan or somebody so that they can understand how much they should put in, how they get the match if you have a company match for the employees, and help them navigate that. So at the end of the day, when they retire, then that one place where they've saved money for retirement, it is the best that it can be for them because they had some help along the way to get them there. And that's what the employer can provide to their employees.
All right, awesome. Well, that looks like all the questions. We have anything else you want to touch on, Armando? Or are you good?
Now, this is a constantly changing space. It's very complex. I would just again say that if an employer is thinking about adding a plan, well, we can certainly help answer questions they might have on that. Somebody who already has an existing plan and hasn't looked at it, they've got to understand there is some responsibility and liability there, and it needs to be looked at by qualified people who understand that space to make sure that that employer, that the owners of that business and the people who are in charge, say HR or CFOs, that they're doing what needs to get done for the organization and for that 401k plan for the benefit of the company and the owners and the employees.
Yeah, and this checklist is available if you need it. Anyways, we'll sign off now. Thank you for joining us for our latest episode of Death, Taxes, Money, and the Law. Thank you, Hermano.
Yep, thank you.